There's one calculation Wall Street quietly hopes you never run, because the moment you do, you stop handing them a slice of your future, and you start keeping almost all of it for yourself. Here's the lie that funds an entire industry. They want investing to feel complicated, too risky to do yourself, too technical to understand, so you'll pay an expert to handle it. The complexity is the product. But the truth is almost insultingly simple. A plain, boring index fund, one that just buys the whole market, quietly beats most highly paid professionals over time. Stay to the end, because the seventh secret is the one that costs them the most. So here are the 7 index fund secrets Wall Street would rather keep to itself, in the order that actually matters for your money. Secret 1 is the silent killer: fees. A 1% annual fee sounds tiny, a rounding error. It is not. Over a working lifetime, that 1% can quietly swallow a quarter to a third of your final balance. The reason is compounding working in reverse. Every year that fee skims a little off the top, and the money it took can never grow for you again. Decade after decade, this small leak becomes a flood. The fix is brutal in its simplicity. A low-cost index fund can charge as little as 3 or 4 cents per $100 a year, while an active fund charges a full dollar or more. Same market, you just keep the difference. Secret 2. The experts you're paying to beat the market mostly don't. This isn't an opinion. Over any 15-year stretch, around 9 out of 10 professional stock pickers fail to beat a simple index fund. Warren Buffett was so sure of this he bet $1 million that a plain S&P 500 index fund would beat a team of elite hedge fund managers over 10 years. It wasn't even close. The boring index crushed them. Sit with that for a second. You are often paying premium prices for below-average results, higher fees, more taxes, and a worse return than the index you could have simply bought yourself. Secret 3. Trying to jump in and out at the perfect moment is a trap, and every trade you make is a fee they collect. The market rewards patience, not cleverness. Here's the number that ends the argument. Stay fully invested for 20 years and you capture the full return. Miss just the 10 best days, which usually arrive right after the scary drops, and you can lose nearly half of it. Secret 4. Your worst enemy is your own emotion. Buying when you feel greedy, selling when you feel scared. The wealthy quietly remove themselves from the decision entirely. They automate it. The same fixed amount into the same index fund, every single month, no matter what the headlines scream. It buys more shares when prices are low, fewer when they're high, and it never once panics. Secret 5 hides in plain sight: dividends. Those small quarterly payouts feel like pocket change, so most people just spend them. That is the quiet mistake. Reinvest them instead, automatically buying more shares, and over the long run reinvested dividends have made up a huge share of the market's total return. The payout buys more payouts. That is compounding doing the heavy lifting. Secret 6 is the one accountants love. An index fund rarely buys and sells, so it rarely triggers a taxable gain. An active fund churns constantly, and you get the tax bill for trades you never chose to make. Take it one step further. Hold that index fund inside a Roth IRA or a 401k, and the growth compounds with the tax drag stripped away. Same fund, but far more of it actually ends up yours. And Secret 7, the one that costs them the most. The winning strategy isn't a clever trade or a hot tip. It's buying a broad index fund and then doing almost nothing for decades. No activity means no fees for them. Left alone, the US market has returned around 10% a year on average over the long run. Not every year, some are brutal, but for the patient, that boring average has quietly built more fortunes than any stock tip ever has. Every red banner and breaking news alert is engineered to make you do something: buy, sell, react. The patient index investor learns to treat the noise as background and lets the average do its slow, relentless work. Step back, and the 7 secrets collapsed into one. Whoa, fees. No stock picking. No timing. Automate. Reinvest. Shelter from tax. Then wait. Every single one is the same move, taking the friction Wall Street feeds on and removing it. That's the quiet divide. Wall Street earns when you trade, chase, and pay for help. You earn when you do the opposite. Less activity, lower cost, more patience. Their entire business is the friction you can simply choose to delete. And this is why it stays a secret. There's nothing to sell here. No exciting product. No monthly fee. No reason to call a broker. Just a dull, repeatable habit that happens to beat almost everyone trying to be clever. So there they are. 1. Fees quietly eat your returns. 2. The pros rarely beat the index. 3. Don't try to time it. 4. Automate it. 5. Reinvest the dividends. 6. Shelter it from tax. 7. And mostly leave it alone. None of this is hard to understand. The hard part is doing almost nothing while the world screams at you to act. That patience is the entire edge, and unlike everything Wall Street sells, it's completely free. You don't need all 7 today. Open one low-cost index fund, set a small automatic monthly buy, and you've already done what most people never will. The rest is just time. If this gave you one idea you can actually use, follow along. This is MOF Money, where we break down building wealth, one quiet move at a time.